Yeah, and you mentioned the COMEX margin hikes, but they also didn't trigger the
Circuit breakers.
yeah, they didn't.
Yeah, how'd that happen,
Yeah,
right? How'd that
twice,
just yeah.
twice.
Well, it's just like when Jeffrey Epstein was in this maximum security federal prison, that the guards fell asleep and the cameras didn't work for once, right? So they just happened to fall asleep and the cameras just happened to not work. So we don't really know what happened. I mean, it's a lie. Everything is
Yeah.
is silly when you talk about the circuit breakers glitched twice, right? And allowed it to free fall. Well, at the same time, you look at JP Morgan covering 700 plus contracts at the exact bottom when this happened. Or if you take a look at the ETF, SLV, when the price fell, right at the time the price fell, and amazingly so, there was a jump in SLV's shares by 37 million shares. And so at 0.905 ounces per share, that's 33 million ounces of silver added in one day. Now, they added that at the very bottom. So in other words, the authorized participants create those shares like JP Morgan and Goldman Sachs, and they do so by delivering physical metal first. So think about what that means. Silver gets destroyed, and immediately after the smash, not only does JP Morgan cover 700 plus contracts, but tens of millions of ounces show up inside the ETF. And that tells you that, this was a forced liquidation and a margin event. And at the same time, they use that event to source physical cheap and inexpensively and park it inside the exchanges where they control it, inside the ETFs. And
Yeah.
in my mind, this is forcing from weak hands to strong hands silver, from forced sellers to institutional vaults. And, I don't know. I think that when you line up the delivery pressure, the tightness in the registered inventories, the big stops that we've been seeing that are breaking, the circuit breakers. This isn't normal flow. This is inventory reshuffling under stress. And I think the most important thing to take away from that is that in periods of chaos and violence, markets do not reveal the truth. They only reveal the truth after. And price is the weapon or the misdirection, the tool of misdirection, and inventory is the confession. So yeah, they can use the price to freak everyone out, but the inventory on both LBMA and on COMEX are speaking a far more accurate truth, and that is that this is something that is going to get a lot more volatile, probably a lot uglier before it gets better, in the respect that the amount of entities that can possibly stand for delivery are way outpacing the amount of silver and gold that are inside the vaults. And I think ultimately you see much higher prices as a result of this imbalance.
Yeah, and even in China and Shanghai, the futures and the Shanghai Gold Exchange,
Yes.
their inventories are falling like massively.
Yes, they
So
are, and that's happening everywhere as a result of the insiders that are understanding what the Western silly price is all about. And so they're not only are the inventories falling, but they're falling using the fake price that we have here in the West as a guide. Now they also have the arbitrage that we're seeing in Shanghai, where they are pricing the metal much higher in Shanghai by over like $30 higher than the West. And there's a lot of confusion on that. A lot of people will say, well, what about the tariffs or the VAT tax?
yeah, VAT, yeah.
But that's wrong, and I think people aren't understanding this, because the VAT tax is not the responsibility of the shipper, it is of the receiver, and only when the metal leaves Shanghai. So in other words, if JP Morgan delivers 50 million ounces of silver to Shanghai, they're getting the $30 per ounce spread. The receiver doesn't pay that tax until the metal is moved out of the Shanghai Metals Exchange. So it's not on the onus of the entity
Yeah,
shipping it.
yeah, Eric Young, King Kong 9888, he's done a lot of like work on that, trying to dispel this myth that there isn't a spread between the West and Shanghai. All the prices that are quoted in Shanghai and gold and also the futures exchange, they're all like net VAT, and they're still like $10, $15 higher. And Andy, you talked about registered inventory. It's dropping like 103 million only left on COMEX, and we're seeing In January, there's loads of delivery, and also in February now, and these are not even like the front months. But I read this kind of article by a guy. I'm not going to use his name, but he's a former JP Morgan bullion banker. And
I
he
read
said
that
that,
too.
yeah, and he said, oh, it doesn't matter because the eligible inventory is still there. But I didn't think you could deliver eligible
You
in.
can't, and that's just again, pardon my French, but that's bullshit, because the eligible category, for example, Miles Franklin has a storage program with 8 vaults throughout North America, one of them being in New York City at JFK. That is a COMEX vault. And I have clients with, all together millions of ounces of 1,000-ounce bars in that vault. They are considered eligible. They are not for sale. They are not going to be sold anytime soon. Now, you can add eligible, and I think when you talk about, look, to that point, the only thing that I could think about that makes it relevant, even a little bit relevant, is that yes, it is ineligible, right, and it is could move to registered, but I think that the issue is not about a COMEX market falling. The bullish bet isn't that COMEX defaults. I think it's simpler, and that is that the price of immediacy rises. And to your point, or to his point, that the market has to pay up to pull eligible metal into the deliverable pile, which is registered. In other words, this backwardation that we're seeing, so to speak, if the price got so high where you are enticed to move your metal out of registered, the deliverable pile, or excuse me, out of eligible into registered, the deliverable pile, fine. But that eligible metal, much of it is not for sale and is in tighter hands. Some of it could be coaxed, I guess, but it's
Maybe
even if you
maybe at $1,000, Andy.
right. But even if it's true, but even if you add that eligible into it, there's 294 million ounces of eligible and 103 in registered. So put it together, what do you get? 397. There's 402 million ounces of paper contracts. So if you take all of the eligible, most of which isn't for sale, and the registered, you're still short, barely.
When people ask me what really happened during that smash in silver, the margin hikes, the so-called glitches, the circuit breakers that somehow didn't trip, I have to laugh a little bit. Not because it's funny, but because the official explanations are almost cartoonish. The circuit breakers didn't trigger. The volatility controls malfunctioned. The market just happened to freefall in milliseconds, while one of the largest bullion banks on Earth just happened to cover hundreds of contracts at the precise bottom. What are the odds, right? It reminds you of those stories where the cameras just happened to be off at the most convenient moment. Sure, just coincidence. Nothing to see here. But here's the thing I want all of you to understand, and I say this calmly, not emotionally. Price is the weapon. Inventory is the confession. When silver was smashed, when gold dropped double digits intraday, the narrative immediately became, see, the bull market is over. Too much speculation. Blow off top. That's what they want you to believe. They want you to focus on price because price is loud. Price is dramatic. Price triggers emotion. Fear is the most powerful emotion in markets. And when you see a 20% or 25% drop in a day, your brain shuts off and your fight or flight mechanism kicks in. But what happened the very next day? JP Morgan covered over 700 contracts at the bottom. The SLV ETF, whose primary custodian is JP Morgan, suddenly had roughly 36 to 37 million new shares created. Each share represents about 0.905 ounces of silver. That's over 33 million ounces of physical metal added in a single day. You don't create new shares in SLV by pressing a button. Authorized participants, the biggest banks in the world, must deliver physical metal first before those shares can exist. So, let's think clearly. Silver gets smashed violently. Weak hands get flushed out via forced margin liquidations. Circuit breakers mysteriously fail to trigger. And then, at the lows, tens of millions of ounces are quietly parked inside institutional vaults controlled by the very banks that helped orchestrate the flush. Does that sound like panic selling? Or does that sound like inventory transfer? Because that's what this was. Metal moved from leveraged, emotional traders into the hands of entities that do not care about margin calls and do not blink at volatility. And when you zoom out, the broader context makes this even more interesting. Registered silver inventory on COMEX has fallen dramatically. We're hovering around roughly 103 million ounces in the registered category, meaning metal that is actually available for delivery. Meanwhile, open interest in major contracts represents multiples of that amount in potential claims. Now, I hear the argument all the time. But there's eligible inventory too. Sure, there's about 294 million ounces in the eligible category, but eligible does not mean for sale. Eligible simply means it meets the exchange's specifications. It could belong to long-term holders, private storage programs, institutional accounts. It's metal sitting in vaults, yes, but not metal committed to delivery. Let me give you a real-world example. We store metal in 8 Brinks facilities across North America. One of them happens to be a COMEX vault in New York. We have clients with thousands upon thousands of 1,000-ounce bars in that vault. That metal is eligible. It's not registered. It's not for sale. It's not part of the deliverable pile. Could it be moved to registered? Technically, yes, but only if the owner decides to sell. And they're not selling. So when someone says, "Don't worry, there's plenty of eligible inventory," what they're really saying is, there's metal in vaults that belongs to people who may not want to part with it unless price forces them. And that's the key. The bullish thesis is not that COMEX defaults tomorrow. The bullish thesis is that the price of immediacy rises. If too many participants stand for delivery, the exchange has 2 options: pull metal from eligible into registered by enticing owners with higher prices, or allow backwardation and spreads to widen until price equilibrates supply and demand. In plain English, if you want it now, you're going to have to pay up. And this is not just happening in New York. Look at London. Look at Shanghai. Look at the Shanghai Gold Exchange inventories falling sharply. Look at the arbitrage between Western spot prices and Shanghai pricing. Even after accounting for VAT, which by the way is paid by the receiver when metal exits the exchange, not by the shipper, the spread has been significant. That arbitrage incentivizes physical flow from west to east. And what does that tell you? It tells you that the so-called Western paper price is not fully reflecting global physical demand. This is a systemic inventory reshuffling under stress. It's not normal flow. It's not retail speculation. It's strategic. Now, I'm not here to sell conspiracy theories. I'm here to tell you that markets behave predictably under stress. Exchanges protect themselves. Banks protect themselves. Margin hikes are not inherently bearish. In fact, historically, they often occur in the early stages of powerful bull markets. They squeeze out leverage. They remove weak hands. They consolidate metal into stronger hands. When the CME raises margin from $18,000 to over $50,000 per 5,000-ounce silver contract in a matter of weeks, that's not subtle. That's a deliberate mechanism to purge leverage. And what happens when leverage is purged? Volatility increases temporarily, price drops sharply, and then the stronger hands accumulate. We've seen this movie before. But what makes this time different is the macro backdrop. We are 6 consecutive years into global silver deficits. Industrial demand, solar, EVs, electronics, continues rising. Governments have placed silver on critical mineral lists. There's talk of strategic stockpiles. The US government is openly discussing critical mineral reserves to protect supply chains. That is not the language of abundance. You don't create strategic reserves for things you have too much of. So when price drops violently and inventory keeps draining, that's your tell. Markets reveal themselves after the violence, not during it. During chaos, price lies. After chaos, inventory tells the truth. And the truth right now is that physical metal continues migrating into long-term institutional control while speculative traders are being shaken out. If you separate yourself emotionally from the screen, if you stop reacting to red candles and start watching vault reports, delivery notices, ETF flows, and international arbitrage, the the picture becomes very clear. This isn't the end of a bull market. This is the transition phase, where paper control meets physical constraint. And when that transition completes, price will not need to be managed. It will simply reflect scarcity. That's when volatility becomes repricing. That's when the game changes. But we're not there yet. Right now, we're in the uncomfortable middle, where the big money is repositioning and the public is questioning everything. And that's usually exactly where you want to be paying attention.